Evening, ladies and gentlemen. Welcome to Corporate Connect's webinar, organized by SIAS and supported by SGX. Today, we have with us our Head of Research, Mr. Benjamin Goh, to share with us on portfolio management, followed by UOB's presentation and Q&A. Without further ado, let's welcome our first speaker. Over to you, Benjamin.
Thank you very much, Christine. Evening, ladies and gentlemen. So my name is Benjamin Goh. We're going to spend about the next 20 minutes or so just going through a couple of things. I know that in our marketing email and all that, we talked about me going through the first half 2020 performance of the STI. I decided that that's not really that interesting. I want to do something else to jazz up the programming. Now at SIAS, we always get questions like, how should I invest and how should I invest for the long term? So this evening, very quickly, in the next few minutes or so, I'm going to show you guys how to create a very simple stock portfolio. All right, so we want to move away from short-term trading and move into long-term investment. So I'm going to be using this free website called Portfolio Visualizer. Okay, Portfolio Visualizer, in the interest of full disclosure, I'm not related to them. I've never worked with them. They don't know me, I don't know them. Basically a website based in the US, and as far as I can tell, it's created by a technology company that sells services to the banks. All right, and they have got this free website where people can go in and create portfolios. And how the portfolio works is that you take historical data, actual stock prices, and with a establish mathematics as well as portfolio theory, optimize the portfolio and create a optimized portfolio that you can see, give you some idea of what your retirement fund might look like in about 40 years. Okay, now just keep in mind this is a US website, so all the numbers here are in US dollar, and the stocks that we can put in are only US stocks. So unfortunately, nobody has come up with an equivalent for the Singapore market. Okay, now whenever we create the portfolios, the first thing we want to know is how old is the investor, because if the investor is relatively young, then generally she can afford to take more risks, and she has got many more years of working years, and therefore her money coming in is gonna be gonna last a lot longer than compared to somebody who is much older. All right, so for the purposes of this evening's example, I'm going to use a person who is 45 years old. All right, so middle age, 45 years old, had about 20 years of working life and about 20 years to go. Okay, so nice round number, 45, and we're going to assume that this person is going to retire at the age of 65 years old, right? So therefore, in this platform, you can see I've put in years retirement as 20 years. Okay, 20 years. And when you want to start investing, you need to pull together a sum of money, and I've put down here the initial amount as 30,000 US dollars. So that's about 50K Sing. So imagine if you've been working for about 20 years and you have not been spending your money, you've been saving diligently, 50K Sing should be about there. And remember, you don't have to just invest using your cash. You can also invest using your CPF through the CPF approved unit trust fund, so on and so forth. Okay. Now the financial modeling doesn't end when this person retires, because this person obviously will live to, statistically speaking, about 85. All right. So generally speaking, ladies tend to live about 2 years more than men. All right. So I've taken the average about 85, just to again keep the numbers nice and round. So this person is 45 years old, years to retirement is 20, simulation period in years is 40 years, because after 40 years, this person will be 85 years old, and we really don't need to simulate anymore because this person would have gone off, passed on. All right, so these are basically the starting assumptions that we're gonna have. Now, if you wanna go back and try this, obviously, free time, this is a free website, Portfolio Visualizer. You can put in whatever numbers you want, and I will encourage you to just have some fun with this and put in some numbers which are appropriate to your own personal circumstance. So obviously, if you're younger, put in numbers which are appropriate for you, you're more mature, so on and so forth. All right, go and have some fun with this. And then you can try to figure out how you wanna put together a nice portfolio that will be able to accommodate your lifestyle choices now as well as during your retirement years. Okay, so this is basically the initial startup. Now I'm just gonna quickly move on. Now we're not just gonna put the money inside there. We're obviously gonna invest it. All right. And again, bear in mind that this is gonna be all US stocks because it's a US website, so we can't choose Singapore stocks. And I put together a very fair, straightforward, kind of plain portfolio, nothing too crazy. And I put together a combination of 6 different companies plus an exchange-traded fund, as well as some gold holdings. All right, so which are the 6 US companies I've chosen? They are Walt Disney Company, JP Morgan, P&G, 3M, McDonald's, as well as Coca-Cola. Now, as you have seen, yes, you can see, right, I've not chosen anything too crazy. All these companies are very well-known companies. They've been around for decades, like, some of them are like more than 100 years, right? So as you know, Walt Disney is the entertainment company. JP Morgan is basically a US bank. P&G is, of course, personal healthcare products. 3M is, 3M. You go to a popular bookshop, you can buy all those tapes and whatever. And of course, they've got offerings for the not just retail customers, but also industrial companies, industrial customers. And you've got McDonald's and Coca-Cola. So again, not too crazy. And I've deliberately excluded companies in the tech industry, the technology industry. The reason is because as you all know, the Nasdaq is hitting new highs and has been on a tear since the beginning of this year. All right, and if you think about it logically, this kind of super outperformance is probably not going to happen for the next 40 years. All right, so after a while, companies like Amazon, Tesla, Apple, and all that, they will all become very mature and die down. All right, and then they are not going to be making that much outperformance compared to the overall market. So we don't want to have those crazy numbers kind of mess up our modeling. And again, technology companies is high risk, high return. So we're going to stick to all these very stable, mature companies that we all understand, and we're going to just continue buying into them for the next 40 years. Okay. Now, number 7 is the S&P 500 exchange-traded fund. Because we've already chosen 6 companies, and we are retail investors, we don't want to spend too much time picking stocks. We just want to buy the entire US market. So we can do that very efficiently through an ETF. And the SPDR SPDR S&P 500 ETF is one of the, or rather, I think it is the largest ETF for the US S&P 500 B caps, as well as it's got very low cost. All right, so we're going to put 30% into this, and the last 10% we're just going to stick it inside gold, simply because gold is always seen as a safe haven. So in case the market corrects, we're going to lose money on some of these stocks. We're going to lose money on the S&P 500 ETF, but at least gold is going to go up a little bit. All right. Again, one last thing about this model is that this model only takes into account price returns. It doesn't account for dividend yield. So later on, when we look at the statistics, you're going to see an annualized return number. Just keep in mind that's just price return. All right, so that means it's a low number, right? Because once you throw in another 2 to 3% of dividend yield, then that's going to propel your portfolio a little bit further. Okay, and now of course, when we talk about US companies, if you're a Singapore tax resident, you do not pay capital gain taxes on US stocks. So all you need to do is to tell your broker you want to sign the W-8 band form. That is to inform the US IRS that you are not a US tax resident and that they will not tax you on the capital gains. All right, but regardless, you're going to be taxed. There's going to be a withholding tax of 30% for US dividends. All right, so that's kind of the just think of it as a tax, right? You just have to pay it. Okay, so this is a starting portfolio. Now, starting portfolio is what we're going to invest in when we are still working. Okay, now what is our retirement portfolio? Now, retirement portfolio, once we retire, we don't have an income, therefore we want to switch to things which are much less risky. Okay, but at the same time, we also need to buy things which will at least let us keep pace with inflation. Okay, so if you just buy purely bonds or put inside your fixed deposit, that's not really going to be helpful. Gold also may or may not going to be helpful because gold doesn't pay dividends. All right, so what we're going to have here is we're going to still have a small amount, minority amount in stocks. All right, but the large part, 60% here, we're going to put inside a bond exchange traded fund. So this iShares Core US Aggregate Bond ETF is basically an exchange traded fund that consists of high what you call investment grade corporate bonds in the US. So all these are very liquid bonds, very stable bonds of the big companies. All right, so 60% are in bonds, 25% are still in stocks, S&P 500 ETF, and we're going to increase our weights to of gold to 15%. Again, in case there's a market correction, our stocks are going to lose money, bonds are going to lose some money, so at least the gold is going to hold up much better. All right, so this is the retirement fund. As you can see, the retirement fund has got a lot less expected risk compared to our portfolio, which we're going to buy when we are working. Okay, all right. Now, we can't have a conversation about portfolio management without talking about the cash flows in and the cash flows out, because our starting capital of 30K is not just a one-time thing, right? So what I put down are 4 different lines here. You've got savings 1, 2, 3, and if you got retirement expenses. Now think of savings as the regular investment plan that you have. So you and your spouse are working every month after paying for everything, household expenses. You got some cash left over. So instead of going out and having a Starbucks or going down to Tung Luk Signatures to splurge, what you do is you go and invest. All right. So as you can see, savings 1 is to invest $1,000 a month. This is US dollar. Okay, every month for the next 5 years. Now, savings 2 is to invest 1,500 every month from year 6 to year 10. And savings 3 is to invest 2,000 US dollar every month from year 10 to year 20. And after when you hit year 20, you're going to retire, right? Okay, so there are 3 different tranches, 3 different types of cash inflows. The reasoning is, of course, as you move on and advance in your career, you're gonna have increments, you're gonna have bonuses, you're gonna be promoted, so on and so forth. And of course, as you get older, your household expenses will drop simply because your kids will have grown up, you have kicked them out, they'll be married, your house will be paid for, so on and so forth. And so it's just you and your spouse. So obviously your household expenses are gonna drop a bit, and then you're gonna have a little bit more surplus cash. So again, with the surplus cash, let's not go out and buy ourselves a $60 pair of Crocs. We're gonna invest it. All right. So that takes a little bit of discipline, but obviously the local banks all have got very good products like the regular investment plans, which will help us instill the discipline, because all we need to do is to tell them these are the stocks that we want to buy, and every month automatically they'll buy it for us. Okay, so that's savings 1, 2, and 3. And once we hit 20 years, we're going to start drawing down on our portfolio because we don't have any more income. So we're going to have retirement expenses, right? And we're going to withdraw 3,000 US dollar per month. Now, these numbers here that I've put on the screen, these are in today's dollars, present dollars, but don't worry, the model will take into account inflation, but this will be in present dollars, today's dollars. So what you see here, withdraw $3,000, but of course in 20 years, it's not going to be $3,000, it might be 5 or 6, but this will be in today's dollars. Okay, so I want to pause a little bit here and let you guys think about this. Are the assumptions reasonable? For example, the stocks they want to buy, I think they're pretty decent, not too crazy. Okay, the financial goals we're going to put here, the inflows and outflows, I think could be quite decent depending on our lifestyle choices. And I also want to kind of point out that in Singapore, it's actually not too shabby to put together a bunch of money. If this, the numbers here are too high, then obviously you and your spouse can, contribute together, so on and so forth. So it's not just all on you for this 1,000 US dollar. You can split it with your spouse. All right, so taxes in Singapore are extremely low actually. So if you're working in the US or in Australia, straight away 30% is going to be taken away by the IRS. But in Singapore, we hardly pay any taxes. I mean, how many of us are paying more than 15% or 10% as income tax every year? Very little. So which means that we actually have to do a lot of we actually do have a lot of surplus cash that we should be probably investing rather than just splurging on ourselves. Okay, so now with these kind of assumptions, let's look at the model results. All right, now very quickly from left to right, you have got 5 different columns, the 10th percentile all the way to the 90th percentile. Now think of the 10th percentile as the worst case 10%, the 90th percentile is the best case 10%, right? So these are kind of your bookends. They are very unlikely to happen. So let's not look at that. So your portfolio at the end of, when you hit 85 is probably going to be somewhere between the 25th percentile to the 75th percentile. And what is the grand number? Now let's quickly go down to the rule 4 here. Portfolio and balance dollar bracket real. So it's real dollars. That means in today's dollars. That means at the age of 85, you're gonna have the equivalent of 425,000 US dollar in today's money. All right. So obviously, in 40 years, this number is going to look a lot higher. It's going to look like it's $946,000, but that's because of inflation. So in today's money, it's 425. So it's slightly more than $500,000 Singapore dollars. All right. And the worst case scenario here is that if you look at this minus 27%, that means at any point in time, there is a possibility that your portfolio will drop. And the worst case here is about minus 27%, about slightly more than 1/4. So the question you need to ask yourself is, if let's say tomorrow my portfolio drops by 1/4, am I going to have to drastically change my lifestyle choice? Can I still pay my bills? Can I still pay for my house? So on and so forth. If the answer is yes, then obviously this portfolio, whatever they've created here, would be good enough in terms of your risk appetite. Okay. And if you move to the top here, what is the rate of return? The rate of return nominal is 7.6%. Now, this is quite reasonable because in the long-term average of the US stock market, rate of return of 8 to 10%, excluding dividend yield, that's generally the case. The real rate of return is about 5.5%. Okay. Now, the question that you need to ask yourself is, well, if the assumptions are quite reasonable and this model is based on, historical prices and the math is good, the math is entirely correct, doesn't that mean that, everybody in Singapore, it's not really that difficult to actually, have $500,000, slightly more than $500,000 Sing dollars by the time we die at age 85. And I think that's a very hopeful story. That's something that I always, try to tell people about, that, we always worry about retirement, but if we have the discipline to actually invest every month for the next 40 years, we are not going to be too far off. And you think about this, if you're now 84 years old and tomorrow is your birthday or 85, statistically, you're going to be meeting your maker real soon. I think it's really fun that you can just go down to the Mercedes showroom and order yourself an S-Class, black, obviously, because you can double as your hearse. Just pay cash and carry because you got more than $500,000 Sing dollars. I think that is a very, very compelling and fun story. Okay, so the message I want to leave to you guys is retirement planning. You should start early. Okay, and if you have got a system like this, or maybe you have got some kind of financial planner that you can trust and all that, you don't have to do all the crazy stuff like buying Apple and Tesla and all that. You can build the very boring stuff, but because of the power of compounding, the power of having so much time on your hands, you are definitely not gonna go to your grave penniless. You can actually get yourself an S-Class, right? That is an extremely good story, I think. Okay, now I've kind of used up all my time, so I'm gonna hand over the mic now to Christine so that she can get the rest of the agenda going. Over to you, Christine.
Benjamin. Thank you so much. So next up, we're pleased to have with us today Ms. Ip Wan Ling, Vice President, Investor Relations of UOB Group. Ms. Ip, please.
Thanks, Benjamin. So good evening, everyone. Thanks for taking time to tune into the presentation. I'm Wan Ling from UOB's Investor Relations team, and it's my pleasure to share with you on UOB. So for those who are not so familiar with UOB, UOB was founded in 1935 in Singapore. And over the past 85 years, it has grown from strength to strength through organic growth and acquisitions. We have established a significant presence in the region with key pillars of Malaysia, Thailand, Indonesia, and Vietnam. And we have the most diverse regional franchise among Singapore banks. And it is our price distribution network which we have taken decades to build, and one that something that could not be easily replicated. We're a meaningful player in the region with a sizable asset of 430 billion as of 30th June 2020. And as a commercial bank, our balance sheet construct is simple, with lending activities being our key credit exposures, and they are comfortably funded by customer deposits. With our common equity Tier 1 capital adequacy ratio at 14% as of June, our capital position ranks highly in the region and is well above the Basel III requirements. And banking is a credit cycle business, and taking a long-term approach to banking is intrinsic to UOB, which is in line with the long-term interest of the founding Wee family and our shareholders. The recent pandemic was an opportunity to demonstrate our support for our customers, as well as our commitment as a long-term player. So we've been working closely with the government and regulators around the region to offer liquidity relief to our customers to help protect the productive capacity of the economies. And in Singapore, in fact, we were the first bank to offer relief assistance to our customers. And more importantly, with our strong balance sheet, robust capital and liquidity positions, we're definitely facing the crisis from a position of strength and looking to emerge with an even stronger regional franchise. And this is also recognized by our rating agencies, as demonstrated by our AA rating, which is one of the highest in the world. So in Singapore, UOB is definitely a familiar household name and bank of choice of many Singaporeans. And Singapore is our home market, and it accounts for more than 50% of our group's profit. And as a leading Singapore bank, with our roots and strength in commercial banking, we have developed capabilities for full banking services across key segments of consumer and corporate banking, as well as treasury and asset management. And UOB enjoys well-entrenched retail banking presence. We're a leading player in credit cards and also major mortgage lender for the private residential home loans. And in the wholesale banking space, we've been helping SMEs grow and prosper since the 1930s. And over the years, we have not only remained as steadfast, trusted partners of these businesses, but also cemented our leadership in this SME banking segment. And UOB's well-established franchise in Singapore serves as a robust foundation for us to pursue our regional ambition abroad. And our strong performance and regional reputation have received strong endorsements from numerous leading publications and trade organizations, as well as the investment community. So UOB has a rich history of more than 80 years, as mentioned earlier. And this chart shows UOB's growth story and demonstrates our strong track record of executing various acquisitions successfully. And banks are sensitive to economic cycles, as we all know, but UOB has been able to generate profits even during the down cycles. And so how do we do this? And why are we able to do this? We believe that discipline and consistency is key in execution of our strategies, and whether during good or bad times. And our CEO, Mr. Wee Cheong, is from the Wee family, who holds an 18% stake in UOB. And with him on the senior management team, alongside other members in the management team, with many years of banking experience, UOB takes a long-term view on growing the franchise, focusing on asset quality and sustainable growth. And today, we have full ownership and control over our regional subsidiaries. And this has played an important role in enabling smooth integration of our operations. And our integrated banking platform also helps in effective risk management by ensuring that risks are measured consistently across our regional franchise. So while we remain entrenched in our home market in Singapore, the growth opportunities lie in the region. From a 5 million population base that we have in Singapore, we're looking at the potential of working with a population base of more than 600 million in Southeast Asia. And today, our regional operations outside Singapore contributes to over 40% to the group's profits. We started our regionalization journey in the early 2000s, and back then, Singapore was already a very small and saturated market, and businesses were already looking for opportunities to grow in regional countries, and often in neighboring countries such as Malaysia, Indonesia, and Thailand. So we followed our customers who are supported by our wholly owned subsidiaries in the regional countries. And also note that UOB is the only bank with a Thai presence. We also added a subsidiary in Vietnam recently in 2018, where we were operating under branch license since 1995. And we're also present in Myanmar, where we have long-standing presence as a rep office since 1994. So having operated in the region for 85 years, we've been facilitating connectivity and sustainable growth of the businesses, big and small, across the region through our integrated and comprehensive network. And on the retail front, we have supported many of our mass affluent customers in their wealth journey. And reflecting the growth potential of the region, more than 60% of our assets under management are from customers outside Singapore. And our conservative approach in growing our wealth management franchise has seen our AUM increasing 9% year-on-year as of June. Increasing 9% year-on-year to 120 billion as of June 2020. And our wealth management business stayed resilient despite the volatile environment recently. So despite the challenging circumstances that we're facing now, our diversified core franchise has shown resilience. So as you can see from this slide, as a testament to the resilience of our Southeast Asia operations, you can see that the operating profits in Southeast Asia grew 13% year-on-year, as compared to a decline of 20% in Singapore and 5% in North Asia. As the economies of these smaller countries, smaller trade-dependent countries such as Singapore and Hong Kong were significantly impacted by the sharp decline in interest rates, as well as the economic lockdowns due to and as well as travel restrictions. And our operations in Vietnam, one of the fastest growing markets in the region, has turned profitable in just 2 years after local incorporation. And in the next 2 slides, I would like to further elaborate on the region's potential. So the macro environment has remained uncertain as the world continues to grapple with the challenges arising from the pandemic. But we believe that the risk remains manageable in Southeast Asia, given that the governments have responded to the pandemic swiftly in terms of lockdown, and also rolled out large-scale stimulus and extensive relief measures with the aim of returning the economy to a sense of normalcy as soon as practicable. And beyond these near-term headwinds, we believe in the immense long-term potential of Southeast Asia. Geographically, ASEAN's proximity to major markets such as China reinforces its strategic role in the global manufacturing and supply chains. And ASEAN has been the 3rd largest FDI recipient globally, as each country has laid many years of groundworks in fostering ecosystems in specific industries. Economically, ASEAN's GDP has doubled over the last decade and is now the 5th largest economic bloc globally. Trade has also grown steadily, and ASEAN is now the 4th largest trading group globally. And demographically, ASEAN's population of over 650 million is the 3rd largest in the world after China and India. Its young, driven, and enterprising population underpins ASEAN's workforce and consumer base in the coming years. And the number of middle-class households is also expected to increase, which will not only drive end market domestic demand, but also intra-regional trade and investment flows. Although the individual countries within Southeast Asia they're quite small, but the collective potential is tremendous. We continue to see opportunity from the realignment of global supply chain, and the current pandemic has definitely accelerated these conversations between trade-off between efficiency and resilience. And although having their manufacturing base and supply chains concentrated in one location is great for efficiency and profits, they have been significantly disrupted by the lockdowns amid this health crisis. More and more companies are looking to strengthen their supply chain through gradual diversification into multiple locations. So Southeast Asia has been seen as a key beneficiary of the global supply chain shift. And for instance, Vietnam is constantly being cited as a key beneficiary for labor-intensive sectors such as furniture and textile manufacturing. And Malaysia, given its developed ecosystems for its electronics and precision engineering. So as the bank with the most diverse regional franchise among Singapore banks, together with our strong balance sheet and as well as our deep local knowledge, in these countries, we believe that we are well positioned to capture these opportunities. In fact, many of our customers have approached us to explore the shift of the manufacturing base. And so to elaborate further on the region's potential, this chart shows the banking penetration growth potential and population sizes in the region. So a key observation that we can infer from this chart is that the key Southeast Asian countries are in the top right quadrant, where the banking penetration growth potential is the biggest. And UOB is present in most of these core markets. And riding on ASEAN's young population, where more than half the population is under 30, we launched Tomorrow, which is ASEAN's first mobile-only digital bank in Thailand just last year. And this bank is designed for young mass affluent millennials. And from our learnings from the Tomorrow launch in Thailand, we were able to accelerate Tomorrow's entry into Indonesia as well, earlier this year with an official launch a few weeks ago, which is another market which has large unbanked population. So unlike most existing digital banks, which acquire a large number of customers, Tomorrow focuses on customer engagement, i.e. high quality customers which transact frequently. And with the initial product offerings, while the initial product offerings in these markets are mostly plain vanilla instruments such as deposits and credit cards, we expect the business to ramp up over time and offer more complex financial instruments as we work with the fintech firms to boost customer engagement and experience. As our customers move up the wealth continuum. So I will now share more about the performance of our business segments. So despite the challenging conditions that we're facing now, our wholesale banking income was stable, backed by our continued diversification across geographies, sectors, and products. As mentioned earlier, COVID-19 has accelerated some of the trends which we anticipated, and corporates are looking to diversify and relocate their business activities and supply chains. And UOB having the most comprehensive networks in the region, we're well placed to seize opportunities from the growing China-ASEAN trade and investment flows. Cross-border income accounts for nearly a third of our wholesale and new industries and players emerging, potential industry consolidation, as well as opportunities to reinvent business models. Our sector-specific insights and solution help to synergize businesses to mitigate risk across their value chains. And riding on our regional infrastructure, our digitalization efforts are bearing fruit as well, especially in the payments segment. More than 3/4 of our corporate customers use our cash management platform, and we saw a 58% increase in cash management mandates, which contributed to higher transaction volumes. And across our global network, we support institutional customers in their asset acquisitions as well. For example, warehousing and in data centers. leveraging our franchise and comprehensive suite of product capabilities. And then next on our retail banking business. And here we are riding on the growing affluence of the region's middle class with our omni-channel and ecosystem partnerships strategy. We maintain our market share across key products such as mortgages, investments, and bancassurance. And in the last 6 months, our housing loan portfolio, which are mainly owner-occupied properties, grew across the region and remains resilient. In fact, in Singapore, we due to the low mortgage interest rates and also pent-up demand for 2 months during the circuit breaker, we saw a strong rebound in the new home sales in June. And the buyers are mainly HDB upgraders and in top-selling projects which are reasonably priced. However, the overall growth is expected to be flattish this year, and we do not expect widespread job losses in Singapore given the strong government support that the government has given for SMEs and households. We are encouraged by the progress of our wealth management business as well. As mentioned earlier, our AUM was up 9% in the first half, reaching a high of 129 billion as of June, and more than half of it comes from our overseas customers, which is served by our regional network of wealth management centers. We also saw a surge in deposits, particularly our CASA balances, reflecting customers' trust in UOB during difficult times like this. And on digital and technology, our continued investments in digital capabilities over the years have enabled us to respond well to changing customer needs and behavior, and have enabled us to be operational resilient to support our customers, especially during this period. During the lockdown periods across countries, we saw strong transaction volumes across our digital channels for both our retail and wholesale bank. So for example, we saw double-digit growth in our UOB Mighty and as well as our Business Internet Banking Plus transaction volumes in Singapore, as these became essential tools as customers stay home to stay safe. And this is expected to grow as the economies gradually recover. And in retail banking, at the heart of our customer engagement strategy is our Omni-Channel Approach, where we engage customers through a combination of digital and face-to-face channels. Our Omni-Channel Approach has proven to be what our customers want, as we rank top in customer satisfaction among Singapore banks. Today, more than half of our customers are digitally enabled. Our mobile-only digital bank Tomorrow, which I've shared earlier, has enabled shared infrastructure and learnings with the rest of the bank. For instance, UOB Mighty version 2, which includes Mighty Insights, is a feature we adapted from Tomorrow, and this has led to growth in customers and as well as higher frequency of usage. And we intend to launch Mighty version 2 in Malaysia and Thailand over the next few months as well. And similarly, in wholesale banking, we have been building new digital capabilities to enable faster go-to-market and improved customer experience for our business clients. And during the pandemic, we have digitalized the entire loan application process for the temporary bridging loan program, so that our SME clients can receive their funds within a week. And today, 77% of our business clients in Singapore use our BIB Plus for their banking needs. So as a long-term player, we will continue to invest in the right capabilities and technology to drive transformation, rather than focus on short-term impact on cost-to-income ratio and returns. And then just before I go to the details of our financial performance, I just wanted to talk briefly about what we as a bank have been doing to help our customers and the community. The past 6 months have drastically changed how the world operates, and the global economy is now moving into the deepest recession in recent history. And at UOB, our strong balance sheet and fundamentals have enabled us to stay resilient so that we can continue to play our role in supporting our customers, our people, and also the wider economy during these difficult times. So for our colleagues, for our people, we have enabled them to work from home safely across the network and while serving customers digitally. And for our customers, we have upheld our promise to be right by them. To more than 1 million individuals and business customers across the region, we extended relief amounting to 16% of our loans as at end of June. And these loans are well diversified and are largely on a secured basis. In Singapore, we are one of the largest lenders of the Enterprise Singapore loans to SMEs. And the rate of application has tapered off, but we're working with customers to pace the drawdown to ensure sustainability over a longer period. Apart from liquidity support, we are also proactively engaging them to minimize the cliff effect when the moratorium or relief period ends. And for our community, we have also been helping the most vulnerable, such as disadvantaged children. And then moving on to our financial performance. Our financial performance in the first half of the year reflected the adverse market conditions. Earnings declined 30% year-on-year to 1.6 billion due to mainly a couple of factors. Firstly, margins were impacted by the plunge in benchmark interest rates and the shift to lower yielding but higher quality assets. We were also conservatively building up liquidity, even though at a higher cost. But we expect the interest rates, which are at all-time lows, to stabilize and margins to also recover slightly in the second half. Secondly, fees were also affected as our wealth management and credit card business were weaker as a result of widespread travel restrictions, lockdowns, and social distancing measures. All this limited customer interaction and also disrupted retail spending. We expect to see a modest fee rebound in the second half as the economies gradually open up and the activities slowly picking up as well. In fact, we have already started to see pickup in wealth management and transaction-based fees in June when the circuit breaker was lifted. Our overall asset quality of our loan portfolio remained intact, and our NPL ratio stayed low at 1.6% as the loan moratoriums and various government relief programs supported the low non-performing assets emergence during this period. While we remain committed to support customers through difficult times, we're also expecting credit costs to rise when the loan moratorium ends, as you know, not all customers can emerge intact out of this health crisis. So in anticipation of such asset quality deterioration, we preemptively set aside higher general provisions to cushion against uncertainties ahead in the recent quarter. While it affected short-term profitability, this is a conservative move that we have taken to strengthen our coverage and also balance sheet to withstand any potential credit migration. And through our disciplined credit policies over the years, we have built a well-diversified portfolio with prudent security coverage. Just to give you a sense of our loan book, so as you can see in this slide, geographically, more than half of our exposures is in Singapore, and the rest is spread across several markets and are not overly concentrated. And by customer segment, 51% of our loans are with large corporates, and 15% SMEs, and also 34% are individual customers. They're all well diversified, and while our large corporate loans are lower yielding, they generate healthy risk-adjusted returns. Majority of our SME exposure is in Singapore and Malaysia, and 80% of them are secured by tangible assets. And by industry sector, building and construction sector accounts for about a quarter of our total loan portfolio. And this is an asset class for which we have developed deep institutional knowledge and strong management track record, given our conservative approach. Our consumer book is mostly in Singapore and Malaysia, and they are well secured with more than 80% in the form of housing loans. We review our exposure to vulnerable sectors regularly, and we are comfortable with our portfolio mix and security coverage. And so as a truly long-term player, we strike a balance between focusing on long-term earnings drivers and as well as maintaining strong balance sheet, as opposed to being short-term focused on earnings. Our balance sheet metrics continue to be healthy, and on the assets front, as you have seen in the previous slide, our customer loans are very well diversified, and on the liabilities front, our liquidity and funding remain sound, with customer deposits being our primary source of fund. Given our position as an incumbent bank and coupled with good standards of corporate governance, rule of law, and stable political environments in Singapore, we benefited from the increased deposits inflows, as you can see in this chart, where we have seen sizable increase in CASA. And in the region, our extensive network also helps to ensure self-sufficiency in funding of our subsidiaries. Our CET1 capital adequacy ratio remains strong at 14% as of 30th June. And MAS has also affirmed the resilience of the local banks based on stress tests under adverse scenario. And then lastly, on dividends, because of our long-term approach that the management had taken, we have not missed a single dividend payment since our listing. And with our strong capital position, the bank actually has capacity to fulfill our earlier guidance of 50% dividend payout ratio. But as you already know, MAS has taken the prudent and preemptive stance on capital conservation and has called on all local banks to cap their dividend, their total dividend for 2020 at 60% of 2019's dividend per share, which works out to be 78% for the full year for us. So as such, we declared an interim dividend of 39 cents per share this round. And we have also turned on the scrip dividend as directed by MAS, but at zero discount, given our strong capital position. And despite the dividend cap, the dividend yield stayed reasonably high, above 3%. So in summary, we are focused on creating sustainable value across our franchise, and we take a long-term view, looking beyond the economic cycles by making investments in our people and our capabilities, so as to realize the potential of our regional growth drivers. As disruptive as they can be, crises come and go, and we believe that the base case for the pandemic to be contained by end of this year, and the recovery to take place gradually thereafter. In the meantime, we are adopting a prudent and measured approach with a focus on stability, and we'll be selectively pursuing growth opportunities. We'll continue to monitor our asset quality closely with robust stress testing to anticipate the worst case scenarios. And our proactive engagement with our customers will hopefully smoothen the impact post-moratorium period. Some credit migration is inevitable, but we expect to stay profitable and resilient. As I mentioned earlier, we have entered the crisis from a position of strength, and we will continue to set aside GP to build up our balance sheet. Our long-term approach means that we will pace our growth, balancing it with stability, and we will not sacrifice our balance sheet strength so that we are capable of extending support to our customers, especially during difficult times like this. This storm will pass, and we're confident that we'll emerge even stronger than before through the concerted efforts of with all our stakeholders. So we would like to thank you for your support, and we will be happy to take questions from the floor.
Thank you, Ms. Eve. In our last segment, we will have a Q&A session. We'll start the Q&A session with the pre-submitted questions, followed by addressing some of the questions posted on Facebook comments. And due to time constraints, we would like to seek your understanding that not all questions may be addressed. Without further ado, we would like to invite the moderator for the evening, Mr. Benjamin Goh, Head of Research, SIAS, the panelists of UOB Group Investor Relations, Mr. Stephen Lim, Head of Investor Relations, Mr. Alfred Chan, Senior Vice President, Ms. Ip Wan Ling, Vice President, Mr. So Ita, Vice President. Benjamin can take it away.
All right, thank you very much, Christine, and thank you very much, Wan Ling, for giving us that presentation and walking us through the financials. Now we got a couple of questions that were pre-submitted prior to this evening. I'm just going to read them out, and hopefully you could shed some light for our the participants this evening. And after we're going to move to some of the questions that came in through social media. All right. Now the first pre-submitted question is UOB's net annualized net interest margin (NIM) has dropped from 1.8% in the first half of 2019 to 1.6% in the first half of 2020. So how will UOB's net interest margin be impacted in yet another extended period of low interest rates?
Yeah, thanks, Benjamin. So as mentioned earlier in the financials, our margins were impacted by the significant decline in the benchmark rates across the regional markets, and as well as the shift to lower yielding but higher quality assets. And in addition, we also took in extra liquidity during the market liquidity squeeze in March and April. So we do expect that we should be able to see a slight improvement in margins in the second half of this year, as you know, the benchmark rates, which are already at all-time lows, to stabilize, and as we continue to work down our cost of funds, as you know, deposits come up from repricing, and as well as when the excess liquidity that we build up at higher cost roll off.
Okay, so it sounds like the NIM is going to be protected to some extent because of lower cost of funding. Okay. The second question that was pre-submitted was, there was a significant increase in the allowance for credit and other losses in the first half of 2020 compared to the full year 2019. So does UOB expect the worst to be over, or should investors expect further deterioration in UOB's loan portfolio?
Okay. I guess as mentioned earlier as well, so our asset quality has maintained intact overall, and the NPA formation was actually low, and the NPL ratio also stayed at 1.6% in the first half of the year, as the loan moratoriums and the various government relief programs supported the low non-performing assets emergence during this period. And our loans under relief measures amounted to 16% of our total loans, as shared earlier, with a fairly balanced split between the individuals and business customers. And of these loans under relief, a majority, 90%, are secured in nature or mitigated by the Singapore government's risk sharing schemes, which would help to mitigate loan losses in the event of default. So while we remain committed to support customers through difficult times like these, we also expect credit costs to rise when the loan moratorium period ends. And also, as mentioned earlier, it's not realistic to expect all customers to emerge intact out of this health crisis. So based on our conservative base case scenario, which assumes that the pandemic would be broadly under control towards the end of this year, we expect credit costs to rise over the next 2 years, and we have preemptively set aside more GP to cushion against the uncertainties ahead. And we expect to continue to do more, to put in more GP to bring the full year credit cost to around 50 to 60 basis points for the year. And we are comfortable with the pace of the provisioning as we entered the pandemic with a strong balance sheet, as well as the fact that most of our exposures are well collateralized.
Okay, so thank you very much for that. So sounds like it is because of the prudent cash flow management that UOB has put in a significant increase in the allowance for credit losses, so on and so forth. So I think that's fair. Now, a couple of questions from our media listening sources. So the first one is, does UOB expect to raise fresh funds through new shares or rights issuance to strengthen its balance sheet?
No, we currently do not have the plan to do that.
Okay, because the reason is that one member has pointed out that in the question in the was it the AGM, there was a recent question about the mandate, whether or not UOB needed to get a special AGM or extraordinary AGM to be able to issue new shares. So that was the motivation for this question, I think.
Yeah, I mean, as previously mentioned, our capital ratio as of 30th June remains pretty strong at 14%, and this is actually one of the highest in the region. So, of course, as we expect to book in more provisions, and as credit costs increase during this for the next 2 years, this year and next year, we definitely expect capital ratio to also come down, but we are still comfortable with the levels.
Okay.
And we believe it will go below 12.5%.
Okay. All right. Sounds good. The next question is UOB's share price has always been trading at a premium over DBS share price as much as $1. However, in recent months, UOB's share price has fallen to a $1 discount to DBS. What might be the reasons for this?
I'm afraid I can't really comment on. I mean, share price has a lot of moving parts, and it's a lot of market dynamics. So I'm afraid I'm not able to comment on this.
Okay. So the next one, DBS and OCBC has successfully built a private banking business, wealth management business. What is UOB's strategy with regards to wealth management?
Well, our wealth management strategy. We would say that it's slightly different from the major private banks. We focus mainly on the mass affluent segment with long-term goal of wealth protection, and we have also emphasized that we actually distribute simple and conservative products, and we generally do not target customers with aggressive risk appetites, nor do we advocate excessive product churning to generate fees. So we believe that our conservative approach in growing our wealth management franchise is a more sustainable fashion, and this puts us in a better position to navigate market uncertainties. Actually, in first quarter of 2020, in fact, our AUM has actually been stable despite the market sell down that we saw in the first quarter of this year. And we believe that our wealth management strategy is our philosophy is that we help customers to preserve wealth in a sensible and conservative way. So and our target market segments are mass affluent customers who have earned their first like $500,000 or $1 million, and we these are people who can't lose their money so easily. So we believe this is a more sustainable approach for us, and we believe in wealth preservation.
Okay, sounds like that's the premium banking segment, is it? $500,000 to $1 million, is that premium banking?
Yeah, privileged banking.
Privileged banking, okay. All right, the next question from social media is, and you probably may have covered this just now when you walked through the financials, UOB's cost to income ratio has increased. What is the reason for this?
Sorry, I didn't hear. Cost to income ratio, is that right?
Yeah, the cost to income ratio has increased. So what are the reasons for this?
Yeah, okay. I mean, as you know, as mentioned earlier, the revenue side has been largely impacted by the sharp decline in interest rates, and the fee side, the non-interest income side, is also has been impacted by the lockdowns and travel restrictions. So the revenue side has definitely come down, and of course we continue to exercise strong cost discipline. As revenue softens, revenue-linked compensation would also be adjusted accordingly, and this serves as a huge lever to the cost, as staff cost actually makes up 60% of our cost base. We have also tightened control over hiring, and we are also, we've also been freezing headcount, for non-critical functions. And discretionary expenses such as advertising and promotion expenses also took the biggest hit, as we have taken this down, as much as 50%. Traveling expenses is obviously gone, with traveling restrictions still in place. But having said that, we are still committed to investing in technology, and so that we can continue to sharpen our digital and product capabilities, and we are definitely reviewing our strategic investments and prioritizing those that will help us to capture opportunities when the situation improves in the future, so that we are able to better serve our customers. Yeah. So I mean, although there are many ways that we can control our costs, our investment in technology will continue.
Okay, so thank you very much for that clarification. And I guess in the interest of time, since it's already one minute past the hour, we have a couple more questions. I'll just pick one last one. This will be the last question for the evening. Just give me a second. Does UOB think that the current pandemic presents a opportunity for M&A? In which specific banking segment or country?
Right now, I don't think we would be looking at any transformational kind of M&A. But I guess small bolt-on M&As are definitely something that we consider from time to time. So nothing transformational that we are expecting to pursue.
Okay, so not expecting to buy DBS anytime soon. Okay, I'm just kidding, folks. This is we don't have any insider information. Okay, that was the last question. That's a wrap. So thank you very much, Wan Ling, as well as the IR team from UOB. Let me just hand it off to Christine. Over to you.
Yeah, so thank you, Benjamin and Miss Eve. We have come to the end of today's session. It has been a pleasure to have with us today. For those who just joined us, this session's video will be on SIAS Facebook page. Do like our page and also check out our website to get more updates on our upcoming investor education programs and initiatives. Thank you and have a great evening ahead.